Morning, Chris. How you doing?
Hey, Brian, I'm good. How's it going, man?
Everything's good. This is Brian Jones. I'm here with Chris Hood, professional options trader, world's most interesting man.
I don't know, man. I still, it's been a year that we've been doing this, and every time you say that, I start getting a little shy. I become like a wallflower.
Well, I think you're pretty interesting. You got some stories. We're talking about jiu-jitsu a little before the recording, and
There's only
some
three
other
things to talk
projects
about
and
in
things.
life. There's only three things. There's trading, jiu-jitsu, and knocking people out. Those are the only three things that really count. So
Hey, I'm down with that. Those are
there we go.
real. Like
There we
those
go.
are all three. So I think the common denominator there are all three of those are there's no arguing with the outcome. You either win or lose. And like there's consequences for your actions.
There's no try. Yeah,
Yeah.
absolutely. That's the thing. Trading is like that. You can't trade with the pretend, hope that you're going to win. You got to trade a plan and trade for real. So, you don't go into a jiu-jitsu match without knowing some techniques, and you don't go into a sparring match in karate without knowing how to block and defend. So, this is definitely defensive mode when it comes to trading at the moment.
So what do you think? What are you looking at with the market now? And we're kind of in a spot where it could kind of go either way.
Yep, I think we're in this no man's zone. I'll pull up my screen here and we can have a look at it. So let me get you back on my screen. Right, here we go. And let's share the screen. So looking at where we are from yesterday. So yesterday's market close, we were right at the bottom here in the sort of mid-range of that volatility band. Now, from here, you can go that way, you can go this way. And what we look like we're going to do this morning at the open is open up above this red zone. So this is a bearish zone. Anything inside that is to the downside. Anything underneath is to the downside. Now we get to the upside. But look at this. The next stop point is 428.
So what level is the top of that zone? I'm having trouble seeing that.
This level here is around 40653. We're going to open up at just underneath the top of that zone. Now, this is the 65-minute chart. We had an MA cross, a 1321 bullish cross 3 hours ago. That was at 12:45. Or sorry, this is the 65-minute chart. So 12:45 yesterday. Squeezes have all gone to the upside. We've got some slowdown on the 3 and the 5. So this is an interesting way of looking at the market. When we start seeing squeezes on shorter lengths, losing momentum, so the 5 and the 10, and now the 15, this move might not be sustainable, right? So what we might see is a gap up and a retrace. So we have to give this time to play out. We need to see these two indicators going bright green and bright blue over here before we can take this seriously, because this is a big gap, right? And the one thing that I try and teach people is don't try and catch 100% of the move. Wait for the move to be confirmed and then trade it. So the easy move is in the white space. So just let this trade for at least an hour. Give it an hour. Let's see where the market is. If it's inside the red zone, don't trade it. If it's outside the red zone and rising, we can trade it. We've got some alerts up here at 410. We're going to do some put spreads from there. We've got some bearish long puts sitting here, which will be triggered to the exit. But we've got some income trades on them as well, right? So we've got some income trades down here on some long puts. So we need this to play out before we start adjusting things, because the scary chart out of all of this is actually this one, right? So this one here, this is the scary thing. So if you look carefully, we're still deeply inside on the day chart, this red volatility band. And we are nowhere near getting bullish on a weekly basis. And this is the scary one. We've only just started falling on the monthly. So when we have a squeeze that's fired to the short side, here outside of this volatility band has now shifted color. This was triggered in April. We can expect at least 3 to 6 months of this pattern forming, right? With that squeeze in play. Look at these squeezes. Short, 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 short. So if you're trading for the long, a long duration, this is where you probably want to be in cash. And you can't really get back into the market until this breaks the 474 level. So I would say if you're trading and you're trading short duration charts, so 1 hour or less, let moves be confirmed before taking a position. If you're trading longer time frames, so you're sort of the buy and hold kind of guy, this is not the time to be buying anything, right? You should be in cash, patiently waiting for your setup. You can't really trade this until we get into the green box here and into the white here. So the 21, the weekly 21, which is up here at 440, that's your trigger. If we're not above that, don't go long. You can trade safely to the short side. You should expect.
So the weekly 21 generally above the weekly 21 is an uptrend.
Yeah, the 21 is a pretty reliable indicator of trend. You can see on the monthly, we've broken the monthly 21 to the downside. We're underneath on the daily, we're underneath on the weekly, we're underneath on the monthly. There's very little bullish news that you can deduct from here. It's a very, very hard, it's a hard place to be bullish. Here, you can be bullish inside these boxes, all right, inside this white space. You can do it, but your trade time frame needs to adjust accordingly. You can't take a 6-month view on a 1 hour chart. That's not going to work.
So let's just take, for example, the daily chart, just to kind of give people, like, to give today's episode a theme. So the daily chart, you've got, 5, 8, or 5, 9, 13, 21, 34, 55, or, all these. So what, can you just break down really quickly what those moving average levels sort of represent for you if you're trading?
Yeah, so when you start breaking down the 8 to 13, 21, 34, 55, 88, 200, when you start looking at it, different institutions will use different levels as trigger points and purchase levels, right? So they'll come in and support. I'm going to put on the 200 here in a second. Let's just do this. We'll put the 200 on. And you'll see the 200 is, for me, one of the keys, because the 200 represents, in fact, let's do this. Let's do the 21, let's do the 88, and we'll do the 200. Okay, so we'll just do those three for the exercise here. Let's just put this on. 1, 2, there. Let's just make them a little bold. So 1 and 2. Let's change that color. Make that one pink. There we go. So there you have it, right? So there's your 200. Here's your 88. Here's your 21. Now, when you lose the 200, all right, one of the things you've got to remember, when you lose the 200, institutions stop supporting the stock. Institutions cannot buy. A lot of these major pension funds have a major risk rule within their investment policy that says if it's below the 200, we can't buy. Right, so it has to get back there.
So that's like mutual funds and things like that, or
so mutual funds, pension funds, any of these long-term guys. This is a key risk point. It's just
this is like retirement type stuff, right?
Yeah. You just can't do it. You break the 200, you've got to go, right? That you've got to exit. And that's why you'll often see breaks of the 200. Selling creates more selling, right? Because as more and more days go by with you being under the 200, more selling is going to take place because you're under the 200. One fund might say 3 days under the 200 might institute a sell action. 4 days for another guy, 5 days, 2 days, 3 closes. All of these things revolve around that price point. So from here, you can see how accurate the system that we've got is, right? There it was telling you to get short, right? This was back on the 14th of April. And, you're out. You should have really been out over here when you had the exit signal there. So when you start looking at the 200, you can't expect institutional support. There's a lot of buying that will take place up here, right? So once the price gets back up there, it's going to be buying creates more buying, right? So people are going to start buying. The funds are going to come back in, and it's going to push price up. Here's the 21. 21 would be for smaller funds.
So let me add another question about the 200. So it's going below the 200, and major institutions are selling. Like, what at that point, it seems to be like a free fall. Like, what would prop it up and cause it to go back above the 200?
Okay, a lot of algorithms will get triggered in, right? So when stocks reach RSI levels or relative strength levels of chronically oversold, and you'll see them Where do we have them here? You'll see on my indicator here, we don't seem to get to these levels fairly often. Yeah, we don't have them very often here, but usually on my stochastic, you'll see, let me see if I've got them on this one here. So you'll have levels. I'm just looking here on this stochastic line. You might see, you can see here on the overbought side, if you look very closely, you'll see these little red dots. You see these red dots that sit up here above that blue line, 1, 2, 3, there.
Right.
Those indicate conditions of extreme levels of being overbought. All right. We can have those levels set also for oversold, right? So usually we would have it on the oversold side as well. Now, what that means is when a stock trades in for an extended period of time at these suppressed levels, algorithms kick in and they go, you know what, this has to be bought because it's at these levels that are so low, and program buying comes into the market. So these are not decisions made by humans. This is just robotics, you know, guys that have programmed machines that are saying, you know what, it can't stay down here for too long. So if this red line was underneath the blue line and it was just tracking like that, you'll see these little red dots form. And those red dots indicate minor buy signals. They're telling me, hold on a second. We are reaching those levels of extension to the downside that cannot be supported in perpetuity. So a reversal is more likely going to happen. So this is why whenever you trade in volatile periods, you've got to be really, really careful about indicators that sit on the chart and indicators that sit off the chart, the oscillators versus the lags, right? The lagging indicators that tell you price has already happened. Price here has already happened for the signal to occur, right? So when I get a signal of a cross of a moving average, it's already happened, right? That's why I triggered. When you look at an oscillator looks at momentum, momentum strength, trend strength. It looks at degrees of overbought, oversold. It's looking ahead. It's saying it cannot stay here for too long. It's going to go up. Doesn't mean it has to go up. It's just saying it's going to go up at some point because it cannot survive at these lower levels. So when you trade in highly volatile times, the reliance is really down here. And once you are in strongly trending environments, you switch to using the moving averages because those tend to give you a sort of sustained view of where price is going to go in terms of a channel. So when you trade, and this is something that I notice a lot with people, often they have a sort of a trade style that doesn't necessarily take into account the weaknesses of any particular indicator. So an indicator is not a holy grail, right? There's no such thing as one indicator works best in all. It's how those indicators fit into your style of trading. It's like if your style of trading is highly dependent on moving averages, okay, but just trade those moving averages correctly. Make sure that your strategies are correct. Make sure your expirations are correct. Make sure that you tie your expiration of your option into the time frames of the moving averages that you're using. Don't mix them up, right? Don't use a 1 week moving average, cross on a 1 week chart to trade a 15-minute option, right? You're not going to get value out of that. So I use both. I find the oscillators very accurate in predicting potential movements to the hour. All right, these things work to the hour. That's the thing. So I know, and looking at these squeezes at the bottom here, I know that when a squeeze fires, we usually get 6 to 10 bars of downward momentum, right? So here's the S&P 500 1 week chart with the squeeze fired. Let me just put the squeeze on the signal. We go here. So we don't have a squeeze signal on that tool over there. So here, let's just open this up, make sure that we get it. And I'll show you what I mean. So when we have a look, we're using that. Let's take this off. We're using just the stochastic. So if we look here, there was the stochastic short trigger, right? You see where the line went from red and it started declining below the 0 line over here. That's where I got that trigger. So from there, I should expect 6 to 10 bars of downward price momentum. And I got 1, 2, 3, 4, 5. Then it started to lessen, right? You see how it came up. So the downward momentum started to decrease and it refired to the short side. 1, 2, 3, 4, 5. So from here, we're sort of halfway through that squeeze firing for the second time. It's not going to give me a second trigger. My trigger is based on the stochastic, not the squeeze. But the squeeze has gone to the short side. So I should expect at least another 3, maybe 4 weeks of trending price to the downside. So now that I've got a level, I know that this level here of 390, 384 is probably going to hold. I don't think we're going to go there. I don't think we're going to go to 340. That would be an extreme move. But from here, I think we might chop around a little bit. There's a lot of buying orders here. There's a lot of support in this zone. We might just chop between 425 and 400. We might just do this for a few months. And that's going to be dangerous for a lot of people who are taking long-term decisions to buy the dip, because we don't know if this floor will hold. What we have to do is see it retest. So it needs to come back down here again, and then it can bounce. And if we get a double bottom, then maybe we're going to see something going to the upside. We'll see what happens when that happens.
So we've got the 200, below the 200. What about the 88? Was that the next one that you had on there?
Yeah, the 200, the 88, then the 55, then the 34. It's really not a matter of one's better than the other. One of the things you must always make a distinction of in moving averages is there's no one better than the other.
Well, which kinds of groups, institutions, people tend to buy at the 88 and 55?
It's more like your medium-sized hedge funds, some of the smaller sort of mutual fund kind of businesses. Mm-hmm. You're not going to have the huge institutions with billions, right? The right. Big guys with lots of billions are going to do the 200, but everyone will have a degree of interest, should we say, in a particular level, right? Sometimes we get small funds buying on pullbacks to the 8, some buy at the 13, some buy at the 21. They might not buy their full allocation at the 8, they might buy only 10% at the 8, maybe 10% at the 13, maybe 10% at the 21, 10% at the 55, and so on. So it all depends on the different type of institution and how they've structured their investment policy, because those kinds of rules are very systemic, right? So when a stock drops past a particular point, 2 closes below that line, this institution needs to sell. The next guy might be, well, I need 3 closes, or I need 4 closes, or maybe I need 5 closes.
But there's a cluster of things around those price points.
Yeah, and every company will be different, right? Remember, each investment company will have a different philosophy and a different strategy, because that's their edge. That's how they create their edge. They're not going to create their edge. If everyone said, we're all going to get up when we have 2 closes below the 21, could you imagine the storm that would happen? Not everyone's going to operate the same way as the guy next door. But there's a general theme, right? So one guy might have 1 close, one guy might have 2, one guy might have 5. Everyone's going to be different, but they're all going to be centered around. This is why I often mention confluence of signals, right? So when you get this cluster of agreement between different indicators all in the same area, right? So where we have, like for example, here on this monthly chart, you can see a vol band switch, a 1421 SMA cross for a trigger. We've also got a break above the 21. Those are what we call cluster, and we've got a squeeze firing to the upside. So we've got 4 bullish sort of, triggers all happening in an area, right? That's a very strong signal, and that landed up being a very strong trade.
So you basically kind of, if you got a cluster of good technical signals, then your likelihood of like all these different funds or different traders using different systems all kind of kicking in at the same time.
Yeah, you've pretty much got a higher probability of winning a trade when you've got clusters of agreement. You've got an issue here. So here, break of the vol band, break above the 21, some chop, squeeze firing to the upside, a 1421 cross, another MA 1321 cross as well. And we've got positive momentum on the squeezes, and our stochastic is above 0. So this this sort of cluster that you have here tells us, you know what, AMD, or sorry, SPY is going up in price. There was your first trigger was here above the 21. It held the 21, squeeze fired, another trigger. So we've had 1, 2, 3, 4 triggers, and now we get the move up to here. So someone who follows, you know, on a break above the 21 with a green vol band, I can buy 1 contract. Squeeze fires, I buy 2 contracts, or another one. Then I buy a 3rd, buy a 4th. He's getting paid today. This guy's going to get paid off today. But he follows a sequence. He waits for one system, waits for another, waits for another. There might be one, you know, for me personally, I don't trade that sequence. I trade a different sequence. So for me, I'll be trading here off the slightly longer time frame. There was the short, we add the puts. We took profit a few times already on those puts. We added more, we're above the 21. Can we close above the 21? This is the key for me. If we close above the 21 on the 130-minute chart in the next candle, so if this gap up can be supported and it stays there, I will close my long puts, take a small loss, and move to the upside and trade the new vol band, because this vol band will change to green on this closing above the 21. So that's how we do it. And you just basically follow the rules. So that one looks good. The 375, I trade the 375-minute chart a lot as well. Here, we're going to be just above the 21. If I'm going to trade the 375, I really want to be above 414, because that's a big move. I don't have any resistance. So you can see for an SPY trade, I've got some movement up to here. I can play around in this bullish zone as well. But this is really the big money trade there. So if I can get the price there, 414.73 with that squeeze, you see how that squeeze is firing to the upside on the 15 and 20? That's going to give me a lot of upside. So you just got to trade what you see. So SPY looks interesting. We just got to let it prove itself. But there are other opportunities in the market at the moment that are, I think, probably easier to trade. One of them is energy. You know, if we look at ERX, we've got some trades on ERX at the moment. You know, green volatility band, there was our break above this bearish zone. There was the trade. So we did some trades from here. MA tool, so 1321 positive cross, change in the vol band, moving average cross, squeeze trigger. So we had the stochastic trigger, all three happening in that cluster. There's the trade as it moves to the upside there on the 65-minute. On the 130, break above that bearish zone, long trigger, 1421 cross above the 21, squeeze firing to the upside, stochastic's gone green. So you can see how these things all align. Now we are losing some momentum here on the shorter duration squeeze, but the stochastic is still above 0. So I can stay in that trade as long as this line stays above 0. If that line starts to dip, then I will have to get out. But there's no, look at the white space above ERX on the 130-minute chart. So that's going to be a big trade here on the daily. Cross of the volatility band there above the 21. Here's your 1421 bullish cross, squeeze firing to the upside. So here also lots of white space on ERX. So if you're trading energy, this is probably the pick of the stocks to trade. We also did a trade yesterday in Pepsi. Here we have Pepsi opening this morning right at the top of that vol band. Now, I did the trade even though I was at the bottom here of this red zone. There was the squeeze firing. How did we know that this was going to move up? Because the squeezes here told us. You can see the squeeze had already gained momentum on the 3, stochastics above 0. Here it triggered to the upside. There it's triggering to the upside. There it's triggering to the upside. You see how the smaller one feeds into the longer ones. It's right. Like this, like a wave. It's almost like, it looks like my jiu-jitsu. You know, it starts from way out there and it just comes at you like a tsunami. You know, that's just a figure of speech. It's more like a tortoise. My jiu-jitsu is more like a snail. Oh yeah, this is what I was saying to you. So when you've got these signals, right? So when you have these extended signals, if we are trading above that, our determined level of being overbought, you see that red box?
Mm-hmm.
Yeah, the red box is indicating, you know what, guys, we can't stay up at these levels for too long. So this is indicating, you know what, don't be surprised when this starts to fall. So here we had 3 divergent highs in a row. That indicates lower prices to come. This is losing a lot of, it's losing its momentum here on the 65-minute chart. You see how this is dropping, dropping, dropping. You see already one dark blue bar. So here, I shouldn't be surprised to see Pepsi come back down, probably down to 174. If it breaks to the downside of 174, it's probably going to come down to 172. My stop level here is at 172.09. I should actually move it up. So that's got to go to 172.66. So when you trade, you always want to trade based on, you know, is momentum on your side? Do you have trend on your side? Do you have anything that's going to push the price up through these red zones? We really don't want to be here. We don't want to be here, right? I'll be honest with you, that this is not the best setup I've ever traded, but looking at the squeeze, okay, looking at the squeeze and seeing the confluence of signals that we had here with the 1421, let's have a look. Can't remember the numbers here. This is a reasonably reliable signal, reasonably reliable, okay? So I can buy one trade and then I can add to my trade on a break, a bullish break above the red zone up here. So if this gets there today, I'll get the trigger and I'll just add to the trade because that's the trade that I really want to do. Look at that white space that sits up here. If it falls down, you know, I can always exit and you know, do it again.
You're saying
So,
the bands are the places where you're
the bands, the signals, it's the confluence. It's always got to be the agreement between two different things agreeing something. So when you see that, that's where you have powerful trades. You know, just having a 920 cross or something, it's not enough. You need a little bit more. So hopefully trade safe. You know, there's still a lot of opportunities in this market, even though it's designed to take money out of your poor pockets into, you know, other rich people's pockets. But trade safely, guys. This is, you know, this is all about planning and preparation. It's not about, you know, luck. You know, we try and take luck out of things.
Absolutely. Well, I appreciate it, Chris. And everybody check out Chris's products over at Rogue Investing /alpha. Sign up for the newsletter, get some info, and drop your questions and comments in the box so we can address them in future episodes. I appreciate it. Chris,
Awesome, man. Good to see you. I like the glasses.
thank you, man. I can see now. It's crazy.
You didn't realize I was this ugly.
I was like, oh my God, who is that?
All right, buddy. I'll see you next Tuesday.
Yep. See you.
Take it easy. See you guys.